Hello traders, the title of the video is how to trade indices like a hedge fund manager. Do you want to trade indices like a hedge fund manager? Do you want to trade the Dow Jones Index or the Nasdaq Index or the S&P 500 Index like a hedge fund manager? What I'm about to share with you today is about practical tips or an advice that you can give to your children for the future, talking about trading indices. If you ask, a professional market analyst, what are the key levels, what is one of the key levels that they are watching constantly, at which price level do hedge funds begin their buying a frenzy, so to speak, all right? They will tell you that is the 55% Fibonacci retracement level. So you may say to me, well, George, we don't talk about 55% Fibonacci retracement level, though we have 55 as a Fibonacci number. The level that we use is the 50% Fibonacci retracement level. So what is happening in a financial market? So suppose a hedge fund manager is on the beach sleeping, having a good time, and then his phone is ringing. On the other side was somebody passing on a very important information to that hedge fund manager. The message is that the Dow Jones, after trending for many years, has now pulled back to the 50% Fibonacci retracement level. The next thing that hedge fund manager will do is to jump up quickly and start buying, the components of that stock index. All right? This strategy is very true for major stock indices, talking about, the FTSE 100, the CAC 40, the DAX 30, the Nasdaq 100, the S&P 500, and the Dow Jones Index. All right, it does not matter. It has to be a major stock index. So what is happening? Those major stock indices do not very often pull back to the 50% Fibonacci retracement level on the monthly chart. I'm not talking about daily chart, I'm not talking about weekly chart, I'm talking about monthly charts. So if they have been going up for some time and then they pull back to the 50% Fibonacci retracement level, the buying frenzy will begin. All right? Because I don't want to talk about the bearish scenario, because this is more true in an uptrend. Because the natural progression of the market is an uptrend. All right? But if you see that for commodities, you can play it in a downtrend also. But for stock indices, the hedge fund very often will buy at a 50% level if the stock index is going up for some time. And now, after a bearish season, as we have seen for 2000, for the Dow Jones from 2000 to 2003, the Dow Jones pulled back to the 50% level. So if you consider, so you see here, it went up, it pulled back, it went up, it pulled back. After this pullback here, it went up all the way here. So if you consider the price action from here, from 1995, that's 5 years. Okay? 5 years it went up non-stop. Now it pulled back to 50% of that 5 years. All right? The hedge fund will start buying. So the strategy will be to buy the components of that stock index that also pull back to the same zone or even in that zone, provided that their fundamentals are solid and they are gaining more market share. But generally speaking, if you are an option trader, you will buy a call option of those indices and you will hold them for many years. And here it is, you go up. Then you pull back again, 100% retracement in this case here. So after this move up, pulling back to 50%, with a 100% forming a double bottom chart pattern at the 50% Fibonacci retracement level of this price move from here to here. Now the hedge fund did not forget that level where they did buy before. Again, they load it. Now we have this move here. So because of the area wave count that have done through for area wave traders at 2-4 area wave YouTube channel, now we have another line here, the level of 9525. So the new trend that I told traders talking about wave count from that level of 9525, we are now again at the top here. If we pull back to the 50% of that level, which is in a zone of 17899, the hedge fund will be again at the rendezvous, the meeting point again for that trend that has started right here in 2010, that is pushing it all the way up here. The hedge fund will be again at the rendezvous of that 50% Fibonacci retracement level to take it up a little bit more before dropping it again one more time. So the general rule is that the mutual fund, the institutional investor, the individual investors that want to buy and hold using call option or buying the component of major stock indices like the FTSE 100, the Dow Jones Index, the NASDAQ 100, the CAC 40, and so on, all the Nikkei 225, all the major indices, Sensex, Nifty, all those major indices will be monitoring the pullback to the 50% level if the index was going up at least for 5 years before pulling back to that 50% sweet spot Fibonacci trading zone of the move of the last 5 years or so. All right. So if there was a trend and then it pulled back to 50% Fibonacci retracement level, or if you see any bullish chart pattern at the previous 50% Fibonacci retracement level, implement a top-down trading method. See the trading volume. You see the trading volume here. Now, as you know, you see here the surge in trading volume. Yeah, at that zone, they take it up. Okay. Again, here you see the surge in trading volume. Those are hedge fund managers. Okay, frenzy buying activity at that 50% level. So the financial analyst will tell you clearly that the level that they are watching is the 55% Fibonacci retracement. So any major, in theory, major stock indices pull back to 55% Fibonacci retracement level in a normal condition. I'm choosing my word carefully. In a normal condition, all right, the hedge fund will jump up and start buying like never before. I believe you already understand what I'm talking about here, and you get the message, and you get it very, very clear. So 55%, they will tell you, we as a technical trader will be talking about sweet spot zone between the 50% and the 61.8% Fibonacci retracement level, the meeting point for the buy-in frenzy of the hedge fund managers. Are you a hedge fund manager, or are you trying to become a hedge fund manager? Let us know in the comment section. Do you want to trade indices like a hedge fund managers? Yes, for sure. Please watch the full length of this tutorial. If you have any question or suggestion, please put in the comment section, and in due course I will be recording another video to answer your specific question. If this video has been truly useful to you, alright, please let us know by giving us the thumbs up. Alright. If you think this is another blah blah blah, mark it down. If you think it's an essential tutorial, feel free to share with your friend on Google+, on Twitter, and also on Facebook. If you have not yet subscribed to our channel, please subscribe to our channel. It is free. We will be recording more amazing tutorials. Stay tuned and subscribe today. So to summarize this video, all right, major indices goes up, pull back to 50% Fibonacci retracement level, monitor the surge in trading volume, understand that they have a high chance to start buying like never before. You want to join them. If you want to buy and hold as an investor, you can buy using the call option, buy and hold for many years, the index itself, or buy the component, the one or two or three or even more of the component that stock index that have more chance to go up, that have excellent balance sheet. You can buy those stock and hold, okay, for the next few years. All right. As always, if you learn something new for the first time, please use a demo account. Practice until you master it. This video is for educational purposes only. It's neither solicitation nor an offer to buy or sell any indices. All right. Until the next time, enjoy yourself and be very happy. We are the GSTW24 traders talking about how to trade indices like a hedge fund manager. Happy trading to you all, and I will speak to you soon. Before we go, just quickly to show you, I forget to do that. Okay, Nasdaq index. All right, you may say, Joe, you were talking only about Dow Jones. So you see the Nasdaq 100 went up. It went below the sweet spot zone between the 50 and 61.8. So from that point onward, in fact, some of the hedge funds will start buying it. Even as it's rolling it down, they'll continue to buy it, buy, until, okay, it reaches even the 78.6% level. Because of the tech Bible in this case, it went below the sweet spot zone. That's why I was telling you that I was choosing my word carefully, talking about in a normal condition, in a normal financial market environment, generally they will start buying between the 50% and 61.8% level. Here, this was an exceptional case. We have a technology bubble, and it went below that level. But some, okay, aggressive hedge fund manager will start buying from this zone, buy, until it start changing direction. Here, it did not find support at the 50% level. But again, as you see for the Dow Jones, it exhibits my favorite chart pattern, the bullish chart pattern, double bottom chart pattern, at the 78.6% Fibonacci retracement level. Attention to the surge in trading volume. You can see again the surge in trading volume well above average, okay, trading volume on the monthly chart. Though we are talking about this strategy, you want to make sure you are applying it on which time frame? A monthly chart is to get your attention. You see that double bottom, not at 50%, now at 78.0% Fibonacci retracement level. Again, the surge in trading volume was at the rendezvous. One more thing before we wrap it up, I forgot those one. Okay. S&P 500, same thing from 1995. So you went now, pull back a bit, 1995. If you consider that trend, that was for 5 years. Okay, from 1995 to 2000, again, pull back to the 50% Fibonacci retracement. The sweet spot zone between the 50 and the 61.8% level. Hedge fund surge. Do you see that? Again, see? The surge in trading volume will help you understand what is taking place. Again, at the rendezvous, people will buy the best components, okay, the most viable stock on the S&P 500 and hold them for many years, and this is what's going on. Or people will use call option and buy the S&P 500 itself and hold it for many years, as you can see here. Again, we see a double bottom chart pattern in that sweet spot zone, talking about the price action from 1995 to 2000, as we have seen for the Dow Jones index. I can go on and on, and then they will say, George, I want the video to be short, and I'll say, yes, I understand. All right? So this will conclude our discussion today, and I hope you will find it also useful, and we put it to use to improve your indices trading. Happy trading to you all, and I will speak to you soon. Thank you for watching.